This lesson looks at what actually drives economic growth, and we're looking at from a GDP by expenditure approach. So just to recap, GDP by expenditure is the most common way of calculating economic activity, and you break it up into different categories such as consumption, investment, government spending, exports, imports. Most economic students learn this formula as GDP equals C plus I plus G plus NX, which is net exports, exports minus imports. In terms of how an economy is broken down, let's just look at what each component accounts for as a share of the economy. So this is a breakdown for the US. And what you notice is that private consumption is about 70% of the economy, government consumption is about 20%, investment accounts for 13%, exports account for 14%, imports account for negative 18%, and what you have to do is subtract exports from imports. The reason for this is to get your net exports, and actually your net exports act as a drag to growth because you're actually importing more than you're exporting. And your imports, they subtract from your economy because they're actually adding to another economy. Okay? Then you also have change in inventories, which are very small. And if you add them up, you get 100% of your economy. So for the US, the largest component is private consumption at 70%. So if you want to know what drives US growth, you have to focus on indicators which will understand what is happening in private consumption in the US. Now, although most economies look very similar in terms of how much each category of expenditure accounts for, there can be large differences. Take, for example, a set of emerging market countries versus the US. So to recap, in the US, private consumption is about 70%, and that figure falls to 60% in India and Brazil, and is actually only 30% in China and 30% in Saudi Arabia. Conversely, if you look at government consumption, in the US it's about 20%, which is similar to Brazil, but it's much lower in India and China, for example, where the government only accounts for about 12-13% of growth. If you look at the investment category, which is about 13% for the US, in economies such as Brazil, India, China, and Saudi Arabia, these numbers are much higher, which makes sense because they're well behind in terms of their economic development, and they have a lack of infrastructure. So they have to have actually much more investment into manufacturing, roads, transportation links, utilities, etc., in order to see their growth rates remain sustainable. And in that sense, investment will remain typically a larger share of their economy relative to a developed market. What's really interesting to note is China's share of investment is almost 50% of the economy. And that's because China has investment-led growth in which the government stimulates so much investment. And actually, that investment is partially from the private sector, but also it disguises a lot of the government consumption because a lot of that investment is driven by government mandates. If you look at net exports, which is the difference between exports and imports, you'll notice that the US is a net importer, which means that its external trade sector actually acts as a drag on growth compared to contributing positively. So if you look at Brazil and India, they also have a net drag on growth. In contrast, China and Saudi Arabia, their net exports has a positive effect. In the case of Saudi Arabia, net exports account for 30% of their pie. And if you look at the breakdown, exports account for about 60% and imports account for about negative 30%. And what this means is that 30% of Saudi Arabia's economy is net exports. The reason why this is the case is because they export so much oil. They're the largest producer of oil, that as a share of their economy, that's actually huge. And what this means that each economy here is different. And because the structure of each economy is different, it implies that policies to stimulate growth and policies in order to stimulate long-term structural changes could be different depending on which country you're looking at. So the point of this exercise is to see how different economies actually have a very different structure. And in terms of stimulating growth, they might require different policies. So for example, to stimulate growth in the US, you might get the most bang for your buck if you stimulate private consumption, which is the largest share. However, if you look at China, you might get most bang for your buck if you stimulate investment, because you're stimulating the largest part of the economy. In contrast, if you want to stimulate growth in Saudi Arabia, you may stimulate net exports, as it accounts for a large share. So depends on what your policy objectives and also the country you're looking at could determine the different set of policies you want to enact in order to achieve economic growth. So what is the best policy in terms of, or what's the best policy mix or the best mix for the economy in terms of growth? Well, there's no real answer to this question because each economy is different and to a large extent depends on the stage of development and structure of an economy. Poor countries typically have lots of investment as they import capital and typically export commodities, and they have a huge infrastructure deficit which they need to plug with investment. However, I would caution that too much private or too much government consumption means that you aren't investing that much in productive capacity. So too much consumption means that over the long term, you're consuming a lot, but you're not investing in your own economy, which could limit growth over the long term. Conversely, too much investment, such as the case of China, could mean that you have oversupply in your economy, which could lead to overcapacity, and in the worst case scenario, lots of bad investments, which could lead to recession. So for example, imagine if you have 100 people or 100 families and you're investing a lot in housing, but you build 300 homes. Well, you don't really need 300 homes. And if you have 300 homes, then what that means is you have excess supply of housing, and people who want to sell their houses, they don't have enough people to sell it to, and it'll all end in tears because these people would have invested a lot of money and they're not making any profit on these constructions, and they'll go bankrupt, for example. So that's what is meant by overinvestment and oversupply. Lastly, if you're too dependent on your exports, such as Saudi Arabia, imagine Saudi Arabia exports about 60% of its GDP, or its exports account for 60% of its GDP. What happens if oil prices were to fall by half in the next 2 weeks? Well, that could really impact the growth of your economy. Or let's say your trade partners, their economy starts slowing down. Let's say you only export to the US and the US has a recession. That means your economy will be hit quite hard. So overall, each economy will have a different structure, and how you want to stimulate growth will depend on the structure of that economy. And each economy over the long term will change in terms of its structure. Private consumption could rise as the government collects more taxes and is able to spend more and invest more. As an economy becomes wealthier, it has less need for investment in infrastructure, so investment may decline as a portion of GDP. A country may discover huge mineral reserves, which from one decade to the next, it could start exporting a lot of energy or commodities, and that could change the structure of its economy. So when thinking about growth in an economy, you have to understand first what is the structure of the economy, as well as how to stimulate that particular component that you want to grow or stimulate.